So, what if I told you the secret to massive trading returns wasn't about being right more often, but about being right bigger? That's the core idea from a living legend, Stanley Druckenmiller. And in this explainer, we're going to systematically break down his famous advice: be patient and then be aggressive. But first, you know the drill. We have to get the important disclaimer out of the way. Everything you're about to see is for informational and educational purposes only. This is absolutely not financial, investment, legal, or tax advice. Please don't act on any of this without talking to a qualified professional. Also, just so you know, this is an AI-generated product that summarizes analysis originally published elsewhere, so all views belong to the original author. And, of course, the big one, past performance does not guarantee future results. All investing involves risk, and that includes the possible loss of your money. Okay, let's get into it. All of the incredible analysis and the system we're about to walk through comes directly from the excellent work published over at reflectionsofreality.substack.com. Let's kick things off with a quote that just flies in the face of everything you learn in Finance 101. Druckenmiller says, "Diversification is the most destructive, overrated concept in our business." Whoa. His point is, when you have a truly fantastic idea, a real home run setup, the worst thing you can do is water it down. You concentrate. This one idea is the bedrock for the entire system we're about to build. So here's our game plan for today. We'll start with the core philosophy and then look at two very different paths to getting the same return. From there, we'll actually build the four-layer engine that makes this whole thing work, showing how it focuses on quality, not quantity. We'll be honest about the price of this kind of performance, and then we'll wrap it all up with this idea of being a patient pig. All right, this brings us to a really fundamental point. Not all returns are created equal. You can have two trading systems with the exact same average annual return, but the journey, the path you take to get there, can be wildly different. Now, this slide really tells the whole story. Look at the red line on the left. That's your typical trading system. It's pretty much always in the market, taking a ton of trades, and see that huge nosedive? Ouch. That is a deep, painful drawdown that just crushes your risk-adjusted returns and, honestly, your spirit. But now look at the green line. That's the goal. Notice those long, flat periods? That's the system just chilling out, sitting patiently in cash, waiting. And then, when the conditions are perfect, it pounces. The ride is just so much smoother, the drawdowns are tiny, and the quality of that return is just in another league. So, let's just spell it out. The generic system on the left, that's a recipe for psychological burnout. You're constantly up, you're constantly down, you're taking these deep losses. It's exhausting. The Druckenmiller approach on the right is all about capital preservation and surgical strikes. It waits in cash, avoids all the market noise, and only comes out to play when the odds are overwhelmingly in its favor. The key takeaway here is simple. The path is the point. So how do we actually build a machine that gives us that beautiful, smooth green line? Well, we do it by building a four-layer performance engine. And each part has a very specific job to do, and it protects the layer right above it. Look at this pyramid. It's structured this way for a reason. You only get to that aggressive, be a pig part at the very top, after you've built a rock-solid foundation of discipline, signal quality, and macro protection. You can't just jump straight to concentration. You have to earn it. And here's how the layers build on each other. First, we lay down the foundation of discipline with something called the trading cycle. Then we filter for only the absolute highest quality setups with the triple play signal. After that, we add a macro safety net portfolio insurance. And only then, when all those things are perfect, do we finally get to turn up the aggression with the adjustment factor. Layer 1 is the foundation. It's all about patience. By forcing all decisions into a strict weekly or daily cycle, the system literally isn't allowed to freak out and react to every little news headline or market wiggle. This mechanically builds in the discipline and patience that Druckenmiller is so famous for. Okay, next up is the quality filter, and it's called triple play. Here's the deal. A trade is only even considered if three completely independent signals all line up and scream yes at the same time. If any single one of them says no or even maybe, the trade is off. No exceptions. It's a really tough gate to get through, and that's the whole point. So what are these three signals? Think of it like a pilot's pre-flight checklist. First, bull percent, or B, tells us the underlying trend is on our side. Second, sentiment, or P, confirms that the so-called smart money in the options market is betting on a move up. And third, positioning, or F, shows that the price is already in a position of strength, ready to fly. We need the trend, the bets, and the current price to all be in perfect alignment.
That's why it's so selective. It's just waiting for those rare, perfect moments.
Layer 3 is the ultimate safety switch, portfolio insurance. This is a macro veto. Plain and simple, if the overall market help is bad, the system is forbidden from putting on any new trades. I don't care if an individual stock has a perfect triple play signal. If the environment is a dumpster fire, you don't add risk. Period. This is all about protecting your capital.
Okay, so we've built this incredibly strict filtering machine. Now let's see the result. By being so selective, the system earns the right to be aggressive. This is the big trade-off. You get fewer trades, but they are much, much better trades, which means you can justify a much bigger size.
I mean, just look at how effective this filtering is. Let's say you start with 100 raw ideas. A typical system might take a swing at 70 of those, a mix of good, bad, and ugly. But our system? First, it applies the triple play filter, which immediately chops that list down to maybe 30. Then, the portfolio insurance veto kicks in, leaving only the absolute best 15 trades. This is systematic patience in action. This is how you wait for what Druckenmiller calls something that really excites you. And this graph? This just shows the beautiful outcome of all that work. The dotted red line is a generic system, always invested around 80%. But the green line is our system. In risk-off environments, look at it. Exposure drops to almost zero as the system protects capital. But in a strong, risk-on environment, it confidently ramps up exposure and presses its advantage. This is what we call asymmetric exposure, and it's the whole point. Let's make this real with an example. Same capital, same winning trade in NVIDIA. On the left, a generic system takes a standard position, and hey, it makes a respectable $10,000. But on the right, our system sees all the signals are green, it concentrates its bet, and it makes $24,000 from the exact same move. That's right, 2.4 times the profit from the same correct insight. This isn't about being a better stock picker, it's about having a system that knows when to bet big on the picks you make. It's the only response that actually respects a truly high-quality signal. Now, a performance profile like this isn't free. There are explicit trade-offs you have to accept to get it. So let's be totally honest about the costs. First, concentration risk. When you size up, a single bad trade is obviously going to sting more. Second, slower deployment. In choppy, sideways markets, the system will just sit patiently in cash while other systems are busy churning away. And third, cycle-induced lag. A weekly cycle means you might miss the very first few days of a brand new trend. These aren't bugs. They are the deliberate prices you have to pay for a structurally better return profile. Which brings us completely full circle. We've built the machine, we understand its output, and we know the cost. It all comes back to a simple but incredibly powerful idea.
So let's just summarize. Instead of a noisy single indicator entry, we demand a 3-gauge agreement for high quality. Instead of sizing every single trade the same, we concentrate only when the market is risk-on. And instead of some coarse, maybe the market is bad filter, we use a sharp macro veto. The result is a system designed from the ground up to chop off those deep drawdowns and amplify the upside.
And it all comes down to this. The entire system we just walked through is basically an attempt to translate this one sentence into computer code. The triple play signal defines what seeing it really means. The portfolio insurance defines when you're allowed to act on it. And that concentration factor, well, that defines what going a little bit crazy really looks like. The real question is, can you build that kind of patience into your own process to wait for the moments that truly matter?